Welcome back. Now, Mpact has delivered a mixed set of results for the year ended December 2025. The Packaging and Recycling Group reported a weak domestic economy and infrastructure constraints continued to weigh on trading conditions. Management says its major investment cycle is largely complete, with the focus shifting to unlocking returns from those upgraded assets. Mpact CEO Bruce Strong joins us now to unpack the performance and the outlook ahead. Mr. Strong, thank you so much for making time for us today. Perhaps let's start with the numbers, right? Revenue ticking higher about 5%, but that not filtering through to your bottom line, which is down a similar margin, right, at 5.3%. Perhaps just walk us through that disconnect.
Sure. Thanks very much for having me. So in this very difficult market, we're actually quite pleased to be able to grow revenue. And that's because we're able to grow volumes in our containerboard business, where we increased our local share of the local market. And we're also able to export more than we did in the prior year, albeit at lower prices. And we also had strong sales into the agricultural sector, most notably the fruit sector. We've seen a marked increase in fruit exports, particularly citrus, which were up 24% in 2025 compared to 2024. That was offset by declines in some of our plastic segments, although at better margins. So our gross profits actually increased. The reason why, and our EBITDA and EBIT were sort of in line with the prior year. But below that line, we had increased interest costs and higher tax rate this year. And that translated to a decline of 5% in the headline earnings per share, compared to the prior period. That being said, we were able to grow our net asset value in the year by 6% to 37.76 rand, notwithstanding the headwinds. So they were, as you correctly pointed out, they were mixed. It was a mixed performance. We're by no means happy with their profit numbers, but in a tight market and a very difficult market, I must say, it demonstrates some resilience in the business, which we are pleased about.
So a tight market, but managing to be resilient. And that brings me to my next question. You spoke about higher volumes, but lower pricing power. Let's zoom in on margin management then.
Yeah, so we had to make a trade-off between either keeping the volumes in the business and running, or holding on to the price and potentially losing volumes, particularly in cartonboard and containerboard. Because in those two segments, we are in a global oversupply situation, which has been a prolonged downturn in that market. So we're facing quite a lot of import threats. And in the containerboard side, we've invested quite extensively in our paper mills. They're very competitive, and we're able to defend in those markets with lower prices. But we maintain the volumes, which means that we probably grew our share in the local market. That was encouraging. On the cartonboard side, we weren't in such a fortunate position, partly because we aren't as competitive cost-wise there. And we've also had a number of interruptions from the Ekurhuleni municipality insofar as electricity and water supplies. We are down for over 30 days in the last year just for lack of supply. And that is very difficult to run a business under those circumstances.
And zooming in on the cartonboard space in particular, that's where we did see that Springs Mill closing down. And I just want to get your sense around that closure and whether it's just a rationalization of one asset, or does it reflect a broader structural shift in the South African manufacturing sector?
Well, I'd say yes. Just to be clear, it's only the Springs Mill in our business, and it's relatively small. It contributes no profit. It's got quite a big turnover. But in a business of 14 billion rand, where we made an EBIT of just short of 1 billion rand, Springs Mill made 2 million rand. So, on a turnover of 1.7 billion, it only made 2 million. So in the context of the group's financial performance, its closure, if it were to proceed, would be actually very much cash positive and value accretive for the shareholders, notwithstanding the trauma that one goes through in these processes. And the rest of the business is in a very strong position because we've invested quite extensively in several of our assets, and they are actually doing well. So the Springs Mill is a particular a situation which is unfortunate, and we're having to deal with it. But I think our actions there demonstrate how serious we are about our portfolio optimization and capital discipline. We've supported the business as long as it was able to wash its face, but in this environment, that's not as obvious. And so unless we find an alternative for one or two of the machines, it is due to close by the end of May. So far as your question around the broader manufacturing sector, I think it's fair to say that South African manufacturing businesses are under tremendous pressure at the moment. facing both imported competition in raw materials, but also in finished goods, which is having a bearing on manufacturing output in South Africa.
Do you think that, government should intervene when it comes to that? Because we are speaking of factors like cheap imports entering the market.
I think government intervention has definitely a role to play, especially as we are seeing more protectionist measures being adopted by other countries, most notably the US in the recent past. But those measures have to be taken in a very cautious way. It doesn't help you try and protect. Let's take Springs Mill has got two paper machines. One is protectable and the other one isn't. And the reason why the other one isn't is because if you were to increase the price of those products substantially, our end customers, i.e. the person who makes a box of biscuits, for example, they will be uncompetitive relative to an imported box of biscuits. And so it doesn't help you protect the upstream manufacturer and kill the downstream manufacturer. So it's not always economically viable to apply too much protection in those areas. But there's no doubt that if we sorted out our infrastructure, for example, electricity and water, and Ekurhuleni has been particularly bad, then you at least give everybody a chance to compete. And if we are proactive in terms of our protective measures like tariffs where they make sense, and it didn't take so long to get them in place, that would help. Although I must say the DTIC and ITAC have both been very supportive in the process of the Springs Mill, and they're trying to help where they can.
Yeah, I think we have heard of measures by the DTIC in other sectors as well pertaining, the manufacturing sector. Bruce, we'll have to leave it there. Thank you so much for your time and taking us through the year that was. Now, that was Bruce Strong, CEO of Mpact.